Hello again, everybody. Good afternoon to those stateside and good evening from me here in London. I'm very excited to welcome you back for an extremely important and topical panel discussion around making money from batteries, so optimal strategies and what you really need to know. So we've got a great lineup of panelists for this session. I'll let them introduce themselves in just a moment. And I will hand over to our moderator, Reid Capalino, who's the Senior Vice President of Business Development at LS Power, who I'm sure lots of you already know. So very happy for Reid to be moderating this session and looking forward to what the panelists have to say. So just a quick reminder that if you do have any questions, please feel free to put them in the chat and we'll get them answered at some point during the session. So yeah, don't hold back if you do have a question, because we do have lots of time for them, and we will be running a poll at the beginning of this session, and we'll be going back to the results of that poll as part of the discussion. So just once again, a very big thank you to our sponsors, Honeywell and Energy Toolbase, for supporting the conference, and to all of our speakers, and of course attendees, and our partners for making the event happen. So I will now hand over to Reid, and we look forward to the discussion.
Lucy, thank you very much. Greetings, everyone. Welcome to our Making Money from Batteries panel. My name is Reid Capalino, joined here by Randy Mann, Eren Ergin, Enrico Ladendorf, Jacob Stubing, and Achim Lehmann. As Lucy mentioned, at the end of our panel, we will have time for questions from the floor. So as she said, please don't hold back during the session. If you have questions, put them in the chat. The more provocative, the better. And we will look to mix it up at the end of our discussion. Prior to getting rolling with our panelists, we actually have a question for members of our audience. I'm going to have a survey question, see what we can glean from audience views. So here is the question. Within the US, how confident are you in the near-term profitability of front-of-the-meter storage deployments? Within the US, how confident are you in the near-term profitability of storage deployments? Please respond, give your views, and once we sort of do a bit of a round robin on the questions, we will show what our audience has to say on that topic. Okay, now to the heart of our discussion. We are given somewhat limited time. We're doing away with intros. We are going to dive right in. If any of you want more on the individual backgrounds of the speakers, I'm sure they'll be happy to indulge you after our panel. But we're going to begin with Randy Mann from esVolta. So Randy, esVolta, successful company. You have an operating battery storage portfolio as well as a development pipeline. Focus of this discussion, as you know, is on making money. Money starts with revenue. So in terms of the revenue profiles of your projects on the spectrum between fully contracted to fully merchant, can you walk us through the mix of revenue profiles within esVolta's portfolio?
Sure, Reid. I'm happy to do that, and appreciate the topic here. Making money is obviously what we're all about, as are you and the rest of our panelists. For us to do that, we really look at how to optimize revenue from a particular battery storage asset. And so to us, that means taking advantage of the flexibility that that asset offers into the marketplace. And in some cases, that will mean contracting 100% of it to a utility or a similar type load serving entity that happens to want to use all of the capabilities of that asset. That's a good structure. It's a proven structure. It's a financeable structure, and we're open to doing that. But we often find, and we do have some projects that are fully contracted in that way. But we often find that we can optimize revenues and optimize the cost effectiveness of our assets for our customers by selling them only the capabilities of that asset that they really want most, and disaggregating the other capabilities and either monetizing them ourselves or selling them to another third party. And so most of our projects actually are of that sort of hybrid structure where we're selling, let's say, capacity to a utility, but then we're managing the energy arbitrage and ancillary service opportunities, into an ISO market. And so that's a very common structure. And really, we find that that allows us to get the best of both worlds. We can take advantage of the flexibility of the asset, sell as much of it to a customer who wants it, and then sell other parts to other customers. And really, I think that's the philosophy that we have. We don't today have any projects that are fully 100% uncontracted on a merchant basis. I wouldn't close the door to that, but we found that to get sort of the best risk return profile for our investors and our company, and then offer the best, most attractive product to our customers, it really helps to have at least an anchor tenant, as it were, in the project for a long-term contracted portion of revenues, and then optimize around that, whether it's in the market or with additional contracting opportunities.
Okay, interesting. That's certainly informative, and I like the anchor tenant analogy. Brief follow-up, Randy, on to the extent you can talk about your portfolio or just more broadly in the market. What is the typical range of contract tenor that you are seeing on U.S. Front of the meter battery storage assets?
Sure. So we're seeing contracts, in some markets as long as 20 years. Those tend to be in places where there isn't a sort of liquid ISO wholesale market that allows you to monetize, energy storage assets. And we're talking standalone energy storage assets here, not hybrid with renewables. So we do see, situations where utilities are willing and interested in signing up for that long of a period. On the shorter side, we're working with some hedge counterparties that might be, looking for even 1 or 2 or 3 or 5 year type contracts. And there's where you get a situation where you might be layering, multiple contracts into a project to create, sufficient level of contractedness. But it really runs the gamut, depending on who your customer is and what particular problem you're trying to solve. So, we really see quite a range, in terms of tenor.
Okay, that's very helpful. Let's move now from Randy in Southern California over to Achim in Munich. Achim, welcome. So interested to hear your perspective. It may be one, the insurance underwriting perspective that folks, our audience, have interacted less with. So can you help us? I mean, my understanding, your team at Munich Re, you help developers and investors bring all manner of generation and probably other energy projects online over the years. Storage, I gather, is now in the wheelhouse. Can you talk about what is leading, your clients pursuing storage to work with Munich Re, and what specifically Munich Re is doing to help, improve either the bankability or the profitability of these projects?
Sure thing. Thanks. Great question. As you mentioned, we come from the generating side. So the whole thing started out with PV. We do a lot of offshore, where we're in PV, we're market leader. Offshore wind, obviously on the classical side, there's classical power plants, and we see energy storage as an enabling technology. So the more renewables you bring into a grid, the less stable it becomes for obvious reasons. You have renewable integration, and that's where we decide, okay, let's go into energy storage as well. What do we do there? In simply put, we secure the business cases of our customers where they intersect with technology. So as Randy mentioned, the contract tenures can be relatively long. Investment horizons can be even longer. And when you put the age of the technology compared to the long-term perspective that investors have together, that might be uncomfortable for some, because reliability becomes a problem, performance becomes a problem, and that pulls back to the manufacturers, because they usually need to give quite strong warranties. That can be a burden on them. And what we do is we backstop the promises that the manufacturers make on the reliability of that technology, be it that the product fails, be it that the product is available, be it that the product performs to the specifications that they promise. And that, to our experience, is not only offloading risks of the manufacturer's balance sheet, that they can focus on what they want to do, which is develop great technology and making money, but it also instills confidence in investors, especially investors that like infrastructure, so more conservative, your pension funds, your insurance companies, actually, our own investor loves energy storage if it is properly secured. And that makes, again, these assets more accessible and the capital more accessible. So it might bring down the financing cost, which again improves the business case to it.
Okay, excellent. And Achim, in addition to those types of technology insurance type products, has Munich Re done, or has anyone done, to your knowledge, any insurance type product more on the revenue side, akin to a proxy revenue swap in the wind space, if you're familiar with those, or is this market not evolved to that point yet?
I mean, there are the pure market risk is always a bit touchy for insurance companies, because we like to separate asset and liability side a bit. What does exist on the renewable side is, for example, you can get lack of wind covers, you can get lack of sun covers. On the storage side, what we're currently developing is if the system fails at a really stupid point in time when you could have, I don't know, made money, grid became unstable, you contracted, now you have liquidated damage on your hands. That risk is something that we're looking into covering as well, basically to get as close as we reasonably can to the original business case without jeopardizing our own stability, because that's what the promise we make builds on.
Yeah, interesting. Okay, good. I want to come back to some of those points. Moving over to Enrico now, and Enrico, staying in this vein of sort of additional services or products that are being integrated, to improve sort of the overall economic proposition of storage projects. Educate us, please. What Energy Toolbase, what products or services are you providing to storage owners, and what benefit is this having in terms of the profitability or financeability of storage?
Absolutely. So Energy Toolbase, we are a leading provider of a software platform for energy storage and for solar. That platform is comprised of 3 products. These products support the entire life cycle of an energy storage project or a solar project. So we have a product dedicated to modeling called ETB Developer. That's our flagship product. It's used by over 2,000 users, over 1,200 companies. And our customers are producing over 3,000 project proposals a week, solar and standalone storage and solar plus storage. And we've been modeling storage for, I think, over 5 years now in that product. And so we work really closely with those customers. As you can imagine, the majority of solar developers out there haven't installed their first storage project yet. And so our goal is to make it really easy for them to get up and going and to figure out, does it make sense to deploy storage? If so, how? And then what hardware is available? What use cases do I need to deploy? Does it make economic sense? And then there's a bunch of nitty-gritty details around, okay, if I'm in California, can I switch to some renewable tariff and increase my savings for the customer? And our tool supports all those workflows and makes it very easy, point and click, to analyze a project, to quickly determine, can I add, how many storage systems to add to make it pencil out, and then you get a beautiful proposal that you can show to your customer. And we've got staff that helps our customers through the whole process as well. And then we've got the second pillar is controls. We have an energy management system called Achim EMS. This is essentially the brains inside of an energy storage system. It issues the commands to control and monitor the system. It supports multiple operating modes. Some of those modes have some very advanced AI functions for predicting load and predicting solar generation. And that control system, Achim EMS, is integrated currently with 8 different storage manufacturers. So you can buy systems from those manufacturers, and our system's pre-installed to work. So it gets dropped off the site, you plug it in and turn it on, and your storage system's operating. And then the third pillar, last pillar, is our asset management platform called ETB Monitor. And this is highly integrated with ETP's Achim EMS and provides a user interface for asset management, performance monitoring, warranty compliance, savings and revenue calculations. And that's all accessible over the web. So the main use cases that our customers are deploying, we have a lot of course, California, our core offering is used, behind the meter for commercial industrial buildings. They're usually doing peak shaving and TOU arbitrage. In California, over the last few years, they've mandatorily put all the buildings on a TOU plan, where their highest cost of energy is in the evening when solar's gone down. So the value of storage has actually increased pretty dramatically in places like California.
Okay, excellent. No, thank you. That sounds like a rich set of offerings. So informative. All right, final one. We're going to be sort of in the service provider space. Then we'll pivot a bit from there. But Eren, I want to just round out this piece with you. Honeywell, big name. Probably got it on multiple products in my apartment. Certainly my humidifier, I think, among them. Excellent product.
So that's go ahead.
Energy storage also in your wheelhouse. What are you guys doing? How are you helping?
So that's the thing, right?
Developers want to be out there making money. How is Honeywell helping them do that?
You would think thermostats, right, or air filters, but that's actually a business that we spun off a year and a half ago. So
I'm not selling my humidifier. Don't worry. Okay, no, your new owner's still making money. But no, seriously,
Honeywell name is still out there for those as well. But no, look, on the industrial side of things is if you look at our background, not only in aviation, we have a division called Performance Materials and Technology, where we have our sustainable technology solutions business as well. That's where we sit. All of these are industrial businesses where we really focus on automation and controls for decades now. So we made the decision several years ago to really take those legacy solutions, leverage them, and apply it to this new industry, right? To green energy, renewable energy, not only because our customers are obviously shifting with their sustainability goals, but there's a big potential, big growth in this energy where we think we can create a differentiation. And because to Achim's point, energy storage is a vehicle or a conduit, the way we see it, right? As the renewable energy generation increases and that penetration continues to increase, energy storage is going to be in the core of it. And with our background in automation and controls, we think we play a unique role here to be able to manage the grid and really help our customers address their pain points, right? This can be behind the meter or front of the meter assets. Randy touched on front of the meter applications. Enrico talked about some of the behind the meter. But for us, it's about focusing on the end-to-end solution. So it's not about really providing the battery or a control system, but it's about how we can provide a fully integrated solution that's going to address the user's issues, right? So it's all about de-risking either the cost or the income of the customer or the investor, right? For behind the meter, it can be about reducing the electricity costs or carbon footprint. For front of the meter, it's going to be creating different revenue generation streams, right? So we look at it as two phases. On the project side, it's more of a CapEx, right? We have our modular system that we can implement. Then we establish our software platform that's going to really drive benefits for the customers in the next 5, 10, 15, 20 years, right? And it's about how you optimize the use of that energy storage system. And we have our supervisory control SCADA systems. We have our edge control devices that we couple with our software platform, which is technology agnostic. You can work with different energy storage systems. Today's obviously technology is lithium-ion batteries. We're not in the business of manufacturing lithium-ion batteries, but the important piece is how you actually integrate that into the system and how you optimize it for each project. And that's where we excel. And that's where we can really create a differentiation for the customer. What we see in the future is today, what you see is like 1 to 4 hours of applications. I think this duration is going to increase with renewable energy penetration. So we're actually investing in technology for non-lithium-ion batteries as well. So that's going to continue to happen. But our business model is not going to change. It's about performance guarantees. How can we de-risk the cost and the income by focusing on what we call key performance indicators for that customer? These might be in energy capacity, availability, reliability, or different revenue generation streams that we can go into on a win-win model, right? Sharing of the savings, sharing of the revenue, or different methods in performance guarantees.
Okay, useful. Thank you. That's informative, and it's interesting. One of the themes emerging from comments of Enrico and Achim and Eren all focused on the de-risking aspect, whether relating to battery performance or controls, et cetera, which, perhaps which is useful. And our panel title may have been in, when I think making money, I'm generally thinking, okay, how do you like just more cash, more revenue? But I clearly, from the overall perspective, we can de-risk and get the same amount of revenue, then that arguably is as useful. And many of the comments our speakers, I think, have illustrated that. Final direct, our last but certainly not least, we're going to go to Jacob, here. So Goldman, certainly not known for opposition to making money, to your credit. Your particular perch at Goldman, at the solar fund you work on, which most of us are familiar with, thinking of, okay, you guys are buying portfolios of contracted solar assets. I mean, that's my maybe uninformed but view of at least a portion of what you do. So now we're talking about storage. We're talking about things that, per Randy's point, maybe have more hybrid revenue profiles. How does storage, are they paired with solar on a standalone basis, hybrid? How does that fit into sort of the Goldman, investment thesis that your fund is working on, Jacob?
Sure thing, and thanks for the question, Reid. So, obviously Goldman's a pretty big organization, and we've got a very broad commitment to sustainability writ large. A little bit over a year ago, our CEO, David Solomon, made the commitment that we were going to put $750 billion in financing to work for sustainability initiatives over the next decade. And as of the end of 2020, we were already 20% of the way to that goal. So I think we're probably going to have to adjust those targets. But needless to say that this is the space that we're very bullish on, and we have we have departments in different parts of the firm that are approaching renewable power and storage from different angles. You are correct that specific to the asset management platform, we're a relatively new group. We've been up and running since about 2018, and largely using outside investor funds. We've built up what is effectively an internal yield co / IPP model, where we're predominantly investing in contracted solar assets. Now, that said, having built up an operating team, we've got a large and growing operating group down in Boca Raton, Florida, that is set up to be able to optimize the uptime and the performance of these assets, including the paired storage assets that we have in our portfolio. That kind of gives us the comfort and the flexibility to explore more active strategies. And so, building off of the success of our current funds, certainly we're no stranger to financial structuring and working with investors. We are actively exploring other opportunities to, again, take a more active management than strictly kind of passive PPA cash harvesting that you would get with a more conservative solar fund. And I'd say at a high level, our thesis is that this is a very exciting market. We're very early in this technology with respect to how big we think it's going to be. And we don't want to wait for the hedge market to totally mature. So I think that there's going to be a fair amount of learning on all sides about the best way to operate these assets in a given market. And at the end of the day, we don't even really know exactly what the rules are going to be. So, if you want to be involved in this, our view is that you're going to have to lean in a little bit on your thesis. And of course, that means making smart decisions. That means really doing your diligence on what we think the fundamental value is that batteries can offer, starting with just the physical profile for different parts of the grid. And then, riding that development all the way from the early stage deployments to as the demand for it continues to increase. And here I think this is exactly what Achim was referring to, that we've got increasing renewable penetration. So there's going to be an increased need for this type of technology. And our perspective is that at some point the hedge markets are going to catch up, but we don't want to wait until everything is completely settled and the perfect market structure and contact structure is designed before we really start getting our feet wet.
Okay. Very, very, very sensible and exciting. I'm certainly look forward to seeing more of what you and your colleagues will be doing in this space. Before we go to more group-oriented questions, I will share the results from our panel, which hopefully everyone can see in the chat box. But just to summarize for any who can't, it seems we have, which is, I think befitting an interesting topic, we have very mixed views, and we have a plurality of attendees believe that are somewhat confident that in the near-term profitability of U.S. front-of-the-meter storage, and then the remaining group is sort of split. Well, roughly, well, it's split not quite evenly between not confident, not at all, and very confident. Very confident is the least. So let's see. Another way to slice this: less than half of our attendees are confident or very confident in the near-term profitability of storage. Okay, well, we can turn to that. Let's go now to some more group-oriented questions. I may address follow-ups, individual questions, but let's talk about, more specific use cases. How are we making money from battery storage? Let's start with real-time energy arbitrage, one of the most intuitive use cases. Which markets, Randy, Jacob, anyone, which markets today do you all believe supported, real conviction in the ability to use storage to make money from real-time energy arbitrage?
I'll jump in there, Reid,
Sure.
and give you a start. And my short answer would be yes. All markets are capable of making money in real-time arbitrage. But seriously, having said that, like from our perspective, it's very difficult to sort of justify investing in a battery storage system if you just isolate down to one particular use case, such as real-time energy arbitrage. And the reason for that is just simple. I mean, the asset is so flexible that it can do so many different things, and it can toggle between use cases every hour, every day, every week, every month, and over time. And so when we look at an asset, we may think that in the first year, it's predominantly going to do, ancillary services, and over time, it'll predominantly do energy arbitrage. But we recognize that, in a given day, it's likely doing all of those things at some level. And so we really value that flexibility. That makes it pretty challenging to, forecast your long-term revenues in a merchant scenario, because you have to think about multiple different markets. And obviously that gets pretty complex when you think about, state of charge and what can your asset do at a given time. How do you, optimize the dispatch of the system? So it is complicated. And I think, I think it was Jacob a minute ago said, you can't really think of this as just sort of plain vanilla cash harvesting, of a long-term PPA. I think that's generally right. Like in battery storage, you've got to be actively managing your assets, both from a physical health perspective, as well as from a market optimization perspective. And that's really what we're trying to set up a company that's capable of doing across all those levels, so that you can optimize revenues. But short answer is yes, but the caveat is coupled with a bunch of other strategies that you can also participate in.
Okay, makes sense, Randy. Let me just stay with you for, unless anyone else has anything on that. Let me just stay with you for a moment before we go broader. So here we go. And you got some questions coming in, which is good. Energy arbitrage can be somewhat abstract. Let's talk about sort of a specific use case, which is using batteries to replace existing fossil peakers. Various projections out there, NREL, IHS, et cetera, believe that in the longer term, this could grow to be a market in the tens or hundreds of gigawatts. Certainly in the early stages, esVolta, correct me if I'm wrong, one of the few players to have at least partly done this with some of your California projects and your PG&E contracts, et cetera. How, just to talk to us for a moment about this use case of phasing out or phasing down peakers, bringing in battery storage to replace them. How optimistic are you about the ability to replicate this strategy across other markets, either more in California or in other markets? Will doing so require longer, sort of projects with more hours of storage or longer duration chemistries? Your commentary on this topic would be informative.
Yeah, so I definitely am familiar with the statistic that you mentioned about eventual replacement of gas-fired peakers, and I absolutely agree that that is a strategy that energy storage should be pursuing. And to that point, every morning I look at the industry rags to see if there's an announcement about some fossil fuel asset that's going to retire. I get excited about that. I clip it out, I send it to my development team, and those are the type of things that we're looking at. Because really, if you sort of look at utility IRPs across the country, every IRP that comes out will have a discussion about aging fossil fuel assets and carbon footprint and how they plan to move away from those, sometimes very rapidly, sometimes over time. And energy storage is usually one of the tools that will be called upon to replace that fleet. Obviously, energy storage is it's an energy limited technology, so it can't on 100% apples for apples basis do exactly the same thing that a storage asset can do. But what I would say is most that a peaker asset can do. But what I would say is most peaker assets are very, very, very infrequently used, right? So they're sitting around for most of the year. They're there when they're called on, and that's a great service. When we would build an energy storage asset to replace that asset, we would be providing that same service, but we would actually be participating in the market on a 24/7 basis. And so, as the grid, if you're thinking of the grid as a customer that you're serving, we're providing some of the same services, but we're providing some different services too. And so it's not an apples to apples comparison, but absolutely over time, we will be replacing fossil fuel assets and fossil fuel peakers, no doubt in my mind.
To add to that, Reid, actually is, I agree with Randy. I think we see that not only in the US, but we see it globally in terms of gas turbines being replaced with energy storage or battery energy storage systems. I think it's a use case and it's a market that's going to continue to develop, but we're seeing signs of that. So if you're looking at backup power, if you're looking at spinning reserve, energy storage obviously comes in as a very credible and viable option. And then on top of that, you have the opportunity to utilize that asset much more throughout the year, right? So those things are going to definitely play into it, and it's going to create an advantage for, I think, battery energy storage systems.
You're muted, Reid.
Unmuted. We have some audience questions coming in. Always music to a moderator's eyes, because I can tune out and just read what's on the screen. No, so let's see. I want to summarize. Let me briefly address, and audience members, please. This is wonderful. Please keep them coming. This is the most useful interaction. Let me briefly address sort of moderator's prerogative. Briefly address two of these and see if anyone disagrees, and then there are two questions relating to topics that we had here as part of our agenda. I want to drill down a bit into those. We have a question about top through revenue streams and expectations for tomorrow, and then IRR expectations decreasing as investors get more comfortable with BESS. Good, important questions. Difficult to answer in the abstract. I'll give my personal view, and then if anyone has compelling objections in our panel. Are IRR expectations decreasing as investors get more comfortable? Other things equal, I would say over time you would think yes, no, because otherwise, I mean, what does sort of comfort mean unless your sort of reduced risk premium is to some extent being reduced? But again, it's going to vary a lot over markets on time. But broadly speaking, again, if you just look at what's happened in other renewable asset classes, one would think that over time, cost of capital should compress, fortunately or not. And then the other question, top through revenue streams, I would say, again, look, it's going to vary by market. The three that the questioner, that Robert mentions in his question, which are, capacity revenues, energy arbitrage, frequency regulation, at least in the US, right? Those are the main workhorses. And I would think that will, in differing proportions, that will remain so for the near term. Does anyone disagree with my?
I would agree with that, actually. That's what we're seeing not only in the US, but also in other parts of the world. I think those are the top three. And one other note here is, I think not one of the energy storage systems that are being installed today are going to be used for the same exact reason they were installed 5 years from now, right? So that's something that we need to underline, I think.
And that is an intriguing point.
The other,
go ahead.
Sorry,
yeah, get Randy.
sorry,
Go ahead,
but
please.
one other revenue, opportunity to think about, which wasn't listed, but I think it's important and maybe becoming a little more important over time is the sort of T&D deferral and replacement. Using storage as an asset to bolster the grid capabilities.
Very good point. And in many respects, look, if you can, people who can crack the code on that, those are probably going to be among the best projects, at least in my view. You can really get an asset that becomes sort of FERC regulated, et cetera. Very good point. Okay, the other two topics that we have questions here, and encourage audience members, please submit other ones. I want to talk for a bit about ERCOT, and then I would like to talk about longer duration lithium projects or longer duration chemistry. So ERCOT certainly much in the news of late. Let's do a couple things. Let's talk a bit about the events during URI and what happened in ERCOT then, and let's talk about ERCOT more generally. So I'm curious, folks in this panel may be more informed than I've been. I know I've been interested following the industry rags, as Randy said, to see if anyone has any storage providers have reaped major gains or suffered material losses during the February events in ERCOT. I've so far seen only one notice of any such, one storage provider who acknowledged an $11 million loss, hedging loss, related to a position they had in the the RSS responsive reserve service market in ERCOT. Has anybody else been aware that's a real interesting natural experiment of real volatility, how storage assets performed during that period?
I think, to be honest with you, when you look at the events, and since Enrico and I actually lived through the events in Houston.
Yes, right, please, of course, go ahead.
No, it's not only one or the other, right? It's not just about wind turbines freezing or the natural gas lines freezing or instrumentation failing. It's a combination of many different things, I think, that created that event. And what that shows us is you have to have the right mix of resources as you go through this energy transition. So what we're seeing is, I think there's going to be more need for energy storage. When you look at Texas, wind is big in Texas rather than solar, right? And we already had projects coming through where you're going to be co-locating with storage. I think they're going to continue to happen, right? But when you look at the events, I don't think you can say it's wind, it's storage, it's natural gas, or it's a nuclear power plant, right? It's just the mix and how it was really managed that created that situation, in my opinion.
No, agreed. And I guess my question was more about whether folks were able to really capitalize on that from a financial capitalize, or unfortunately
not that I heard of, except for the one that you mentioned. But we see more investment opportunities coming up right now, to be honest with you.
Okay.
Yeah, I think just the utter length of the event. It was 4 or 5 days.
4 to 5 days, right?
Right. So, and then prices stayed at $9,000 almost the entire time. So if you look back through history, there's been some shorter lived polar vortexes up in the Northeast where you see kind of a microcosm of the same exact factors where batteries would do pretty well.
Yeah.
Where they actually get a chance to charge at some point. Right. When you got $9,000 energy, you can't even charge the batteries.
And this is a good segue. I think it's a good question and a good segue into, I do want to make sure that, let's see, did we adequately address the one question we had about ERCOT more generally? Well, let's just let's stay with this, then we can turn to ERCOT. How this question of energy storage is, energy storage and its role in providing grid stability, and potentially opening up new use cases. But the challenge that Enrico, as you mentioned, it was a multi-day event. And if you had a storage system, fit for 1 or 2 or 4 hours of storage, then those by and large are the most profitable use cases now, right? That's where you can make money. You don't need to have 8 or 10 or 100 hours of storage. As these, grid instability in ERCOT and California continue, I'm curious for the panelists' views on whether this is beginning to create a real actual business case for longer duration lithium projects or longer duration chemistries entirely that maybe can have the ability to store dozens of hours of energy, let's say. What are our views on this topic?
Maybe I can chirp in it. I mean, we see quite a few projects, especially replacing backup generators that don't necessarily rely on lithium ion, more move towards flow battery technology,
Right.
even though it's kind of niche for a lot of players. But exactly in that space, you have the longer durations. You can just have it sit there without it degrading heavily. So there are technologies that move into it. Would it solve a multi-day event? Probably not. But one development that we've also seen is energy storage battery projects augmented by diesel gensets, even though that kind of turns the old logic on its head. And you might be seeing that. Obviously, will it solve a multi-day event? Probably not. That you can only get with a more resilient grid, but it can help short outages, or if you can get the grid fixed up relatively quickly.
And to that point, I agree. I don't think from a resiliency perspective for a 4 to 5 day event, maybe that's not what the new technology is going to be for. But what we're seeing is just because of the renewable energy generation increasing, California maybe is going to be the first state and the region we see this in. You're going to have in excess of 4-hour storage, maybe up to 16 hours, where non-lithium ion technologies are going to, I think, play a bigger role. And that's one of the reasons we're investing in that technology, actually, because that's what we see in the next 5 years. You're going to be seeing longer duration storage coming up. That doesn't mean lithium ion is still not going to play a role. I think you're going to have use cases where you're going to have lithium ion and some other non-lithium ion technology. So they're going to be complementary, in my opinion, but I think you're going to definitely see that coming up, long duration.
So Reid, I think that the real question here, when you have to deconstruct a view of, is this going to create demand? You need to think about kind of two different sources of demand. One is demand from the ISO, which stands in as the proxy for load. And then the other perspective is load that actually wants something behind the meter in order to have that reliability that they're willing to pay a premium for that isn't necessarily reflected in what you're seeing in front of the meter at the ISO. And I think that what we've seen in the previous polar vortex events that were just mentioned is that market design shifted in order to kind of add a stick to the carrot in terms of pay for performance that we saw with capacity and PJM. Obviously, ERCOT not having a capacity market, you have a lot of carrot in that if your interconnection was still was still available. If you weren't part of the load shed portion of the grid, then you could charge at $9,000 a megawatt hour and turn around and sell spin for $22,000 a megawatt hour. So, a lot of batteries did very well with that profile. In terms of making future investment decisions, are you going to build a longer duration battery in order to maybe make money on that sort of event again? I think the two considerations are, A, longer duration battery wouldn't necessarily have been more lucrative than a short duration battery in ERCOT. And, B, if you weren't available and absent some sort of outside hedge that gave you a kind of natural short position that you had to cover by being active in the market, then it was just opportunity cost. So, if that opportunity cost actually gets translated into negative cash flow through the vehicle of the hedge, then of course you're going to take that in consideration. But I think the easiest answer is that people will be more reticent to enter into financial hedges for things like RRS. It's not clear that, while I think we would very much expect to see high reliability premium paying customers take a look at these options for more resiliency behind the meter. With respect to the market design of ERCOT, again, there's a lot more carrot out there, but at the end of the day, that's effectively been the debate that ERCOT's had for the past decade. Can you just waive the possibility of massive price spikes in front of investors and hope that they're going to build a resilient supply stack?
Insightful commentary, Jacob. Thank you. I make it useful for our audience to hear. Guys, we are running near our end of time here, so I want to end with a bit of a sort of lightning round robin. To the extent that you have, as you saw in our survey poll, we had sort of less than half of our audience members confident or very confident about the near-term profitability of front-of-the-meter storage in the U.S. So to the extent that any of you have confidence in that, in that reality, what one trend, either technology related, policy related, financial innovation, makes you most optimistic about increasing profitability of storage deployments? And we'll go in the order in which I see you on my screen. So we'll start with Enrico, and then we'll go to Achim, Eren, Jacob, and with Randy.
So
Enrico,
the trend I see for profitable projects are favorable state policies. You look at New York and Massachusetts, and they're pretty complex revenue stacks, but I think they can work.
Excellent. Good. Achim?
I mean, ultimately, I think cost of technology coming down, or cost per storage unit coming down, even though that will create problems for some of the market players. Maybe we see consolidation, we don't know. But ultimately, similar to PV, which is now cheapest electricity source in some markets, I think that will bring down the hurdle and the cost, and then therefore revenues are freer.
Well said. Well said. Okay, Eren?
Yeah, I think it's going to be a combination of costs coming down, but there's going to be a limit there as well, right? There's going to be some consolidation that I see in the market. And then the most important thing is, like we said before, how much of this revenue is going to you're going to be able to stack. And regulations are going to help with that. The market maturing, renewable energy generation increasing is going to help with that. But revenue stacking is going to be the key here.
Understood. Jacob?
I have to agree with the previous panelists that it's cost coming down, but what I would add to that is that the R&D that's flowing into this space isn't totally reliant on electric power. Energy, obviously very cyclical, very boom bust, but in a lot of ways we're able to get some free rider benefit from the R&D that's going into EVs and other places that you can put lithium ion. So the technology is going to keep getting better, whether or not the market for batteries for the power grid is able to quickly figure out how to deploy.
Amen. Randy, you have the last word, sir.
Great. Those are all great points. I'm going to add one other thought, which is just volatility. Energy storage is made to profit from volatility. It's kind of an antidote to volatility. And I think we can all, agree that we're living through some very volatile times. We're in the midst of a black swan pandemic. We just had the, polar vortex in southern Texas. We had brush fires and heat waves out here last year. We had a insurrection at the Capitol. Thousands of things are sort of going off the rails here. And but what we want is a reliable and affordable energy system so that we can all get back to our lives and thrive. So I see energy storage as being needed to help deal with that volatility and profiting from that volatility, because it's of the service it's providing.
Perfect, a perfect succinct summary to end our panel. And there was a great, I think, diversity of perspectives there. State level mandates, cheaper technology, revenue stacking, free riding on EVs, and just capitalizing on and solving volatility. Those are all important qualities. I want to thank all our panelists, Enrico, Achim, Eren, Jacob, and Randy, for sharing their perspectives with us today. Thank Lucy for organizing, and thank everyone in our audience, particularly those of you who submitted questions. I see Blair, Thomas, Robert, Douglas, etc. Thank you for your contributions. It's been, I think, a very fruitful discussion, and we look forward to seeing everyone again soon. Lucy, back to you.
Great, thanks, Reid. Just want to echo your comments. Thank you to all the panelists for the very insightful, very, very interesting and short-lived. I feel like we could go on for much longer, but unfortunately there's never enough time to cover everything that we want to cover. So thank you all for sharing your experience and your insight. And as Reid said, thanks very, very much to the audience questions, because they always enrich the discussion a lot. So thank you, everyone. We'll shortly be reconvening for our final panel discussion of the day, which is dedicated to investment into energy storage. So we've got a couple of great panelists lined up for that. But yeah, thank you, everybody. And we will see you shortly.
Excellent. Thank you, Lucy.
Thank you.
Thanks, everyone.
Bye.
Bye-bye.
Thank you.